We'll admit everyone, sir.
Salva?
Yeah, we'll start, sir. Admitted everyone, rest will join gradually.
Yeah, okay. Shall I go ahead live?
Yes, sir, please start.
Yeah. Good morning. Warm welcome to each one of you on behalf of SIRC and on my personal behalf. I wholeheartedly welcome you for today's session. SIRC has taken initiatives on a series of Ind AS and accounting standard sessions on Sunday. I hope everyone is safe and healthy. And because a series of programs which is started on every Sunday, so it is a knowledge dissemination session, and we have a very young and energetic and most knowledgeable speaker, Arun Kumar Rajgopal. I also wholeheartedly welcome you, sir, on behalf of SIRC and on all the members present here today. And this is my proud privilege to introduce Arun Kumar to August gathering. Arun Kumar Rajgopal, sir, is a chartered accountant and a certified internal auditor. Arun is an audit partner with PwC, Chartered Accountants LLP, based out of Chennai. He has over 20 years of audit experience in the leading MNCs with a large and established Indian operations, listed entities and companies more. So he is automotive, IT and ITES segment and advising companies on gap change, including Ind AS. He has also working knowledge of international accounting and reporting requirements and has worked on the engagements of requiring SOX reporting and reporting under US GAAP, IFRS and US GAS and PCAOB standards. He is also an instructor on Ind AS and conducts various training sessions with his firm. Arun has also conducted a workshop on specific accounting topics for clients and spoken on accounting and auditing topics under the auspices of SIRC of the Institute of Chartered Accountants of India. With this brief introduction, I welcome you on today's session, sir. And today, Arun Rajgopalan is going to deal and giving a knowledge and knowledge announcement on accounting standard AS 19 leases and Ind AS 113 fair value measurement. So we'll hear from Arun Kumar Rajgopalan. Over to you, sir. And I once again wholeheartedly welcome each participant for encouraging us to conduct many programs on SIRC platform. That too, even Sunday, we have more than we have reached participants of 100. So really, it is an encouraging one for the SIRC and the initiative. I thank Jalapati chairman for taking these initiatives and having a good knowledge dissemination on other areas also, not only a traditional area, Ind AS accounting standards, or the which youngsters can concentrate more on these areas for awareness. Thank you, one and all. Over to you, speaker.
Thank you, sir, for the generous introduction, and good morning to all of you. And I'd like to thank SIRC for the opportunity to present on a couple of accounting standard topics. So it's very heartening to see so many of you on a Sunday morning. So without much ado, I will start off with those two topics which are for the day, which is the fair value measurement standard and also the employee benefits standard. So to kick off with fair value measurement, in the Ind AS world, just to give you a preamble, today, I mean, we've all been used to and still used to historical cost measurement as a requirement. So with the advent of Ind AS, and then there were a couple of standards even in the earlier gap where one would still look at fair value as a concept, albeit not necessarily in a very consistent manner for many accounting captions that we used to audit or look into. But with the advent of Ind AS, fair value measurement is one of the things that has been looked into more closely because that's also fairly, I'm sure all of you would know, because of the requirements, how a stakeholder perceives, how a shareholder perceives, would like to know what are the real-time measurements in the context of in comparison with historical cost measurement. So the standard setters have given the overriding theme of fair value coming through in multiple line items of balance sheet. Set out certain guiding principles of how do you do a fair value measurement, because fair value as a measurement is a very evolved topic. It is judgmental, it is complex, and so they required some guidance which could be prescriptive in terms of determining the fair values of assets and liabilities as and when required. So this standard tries to capture that, and what I've aimed to do is to kind of give an orientation to some of the key things that we look at as we look into the fair value as a concept, and what are the guiding principles that one need to look into. Nevertheless, the standard is fairly detailed, and there are finer nuances, but so if there are any complexities, any real life situations, I think the standard is a very good benchmark for considerations of those. With that, moving on to the next slide, typically the applicability of the standard, as in any standard, the standard is where another Ind AS standard permits or requires fair value measurement or disclosures. Except in couple of instances or 3 instances, which is share-based payment standard, because there is a guiding standard for that, which kind of gives the basis for determination of fair value of the options and the shares which are being granted. So there are guiding principles around that. Leasing transactions, because again there are guiding principles in terms of how leases have to be accounted, and in terms of NRV for inventories and value in use for impairment. So barring those, wherever there are fair value requirements, the current standard of Ind AS 113 is a very good benchmark or guiding principle for the practitioners to look upon to ensure that the fair values are appropriately considered, and consequently after measurement the disclosures are also made. Similarly, in terms of the disclosure requirements, the standard has prescriptive guidance on how a disclosure should be made, what are the types of disclosures should be made, so that the user of the financial statements is appreciative of how the fair values have been determined. And to this effect, there are certain exclusions in terms of employee benefit standards. It talks about plan assets in terms of any employee benefits, what are the disclosures to be made. So those are again prescribed with those standards, and hence the relevance of the standard is not there in as many words. And similarly, where assets are held for at fair value less cost to sell, and they are disclosed in that manner, then the Ind AS 36, the impairment related standard, governs the disclosures in itself. So barring those, if you look into it from a financial asset or a financial liability, non-financial asset, it could be land building, investment property related disclosures. All of those measurements are all typically driven by the principles enshrined in this standard. So at a very preamble level, if you see, there are multiple line items which could be exposed to fair value measurement, either by choice because of an accounting policy exercised, or as required by the standard in itself in terms of measurement. So all of those, the underpinning theme would be applicability of Ind AS 113. And that's something that as practitioners we need to take guidance from. If I may move on to the next slide. Next slide, please. Yeah. So if you move to the next slide further, basics of fair valuation. So the next slide, please. Yeah. So the definition of fair value. So the fair value definitions are pretty clear in terms of what is fair value. Fair value is the price that would be received to sell an asset or transfer a liability or pay off a liability in an orderly transaction between market participants and measurement date. So some of these are the key terms that are looked into in the context of fair value. So it is to say that in an arm's length transaction between two unrelated parties, if any sale or purchase has to be made, what is the price at which this whole transaction is effected? That is precisely the concept of fair value, which is not fundamentally different from what we are used to as fair value in a real term sense, because fair value has its wider application beyond the accounting remit, and there are other tax and other regulatory aspects where fair values are considered. Sorry, if you can please stay put on this itself for a minute, sir. Effectively, if you see some of the key indicators, the lead indicators that one needs to look into are the exit price, which is nothing but the price at which you would exit the transaction, which is sell the asset or settle a liability. So that is the price at which that is being made. market-based measurement and not entity-specific. So this is again very important in the context of market participants. See, one of the factors that the standard prescribes is how a market participant will view. It is not just the perspective of the entity which is actually as part of the transaction, but it has also got to do with how a market participant, if a person is to buy or sell an asset, he or she or the entity that is actually in the market, how would they perceive the asset? Is also a fundamental principle that one needs to bear in mind as the the whole fair value is determined. And this is not necessarily there could be distress sales, sales which are forced in nature because of liquidation. So those typically are not a part of this, because this has to be, as I said, in an orderly transaction, not in a distress kind of sale. So those would not necessarily be a reflection of the fair value, because there is a compulsion to sell or to liquidate. And these fair values are typically determined at the reporting date. So as at the balance sheet date, what is the fair value is what is determined. And it could be for an asset or liability, as I mentioned. And in this context, there could be certain transaction costs that are incurred, because as you embark on selling an asset or extinguishing a liability, there are certain transaction costs, could be the diligence cost, could be advisory cost. All of those are to be dealt with in accordance with the respective standards, and these are not an accretion to the fair value. So the fair value is over and above this value, and so in more often than not, we may be associating a transaction cost to typically the fair value itself. But the transaction cost is completely independent. So if it has to be expense, then it goes as an expense, because these are not necessarily part of the fair value. Fair value is a separate value which is beyond the transaction cost. But on the contrary, if there is, let's say, a transportation cost, because you have to move an asset, a non-financial asset, from a particular place to another place to sell it, and so there is a transportation involved. So those could be fundamentally looked into from a fair value measurement standpoint. But typically, the transaction costs are excluded from the fair value that is being determined. So at a very conceptual basis, a fair value is precisely an aggregation of some of the salient factors that one needs to look into in determination of it as at the balance sheet date. If we can move to the next slide, please, sir. Yeah. So a further iteration of this, as you look into the approach, typically would be that when we say an asset or a liability, it could be a standalone asset or a standalone liability, or a group of asset or a group of liability. And hence, the unit of account is very important to say that is it a separate cash generating unit, which means it's an aggregation of assets and liabilities which are generating cash, and hence I actually sell them off in unity, or is it a separate asset? It could be a separate financial asset, a receivable, or a loan which you could sell off, or it could be a separate fixed asset that could be a property, plant and equipment, or a land that could be sold. So what is more important is, as we determine the fair value approach, what is the asset or the liability that is getting extinguished or sold is very relevant, and hence one needs to know the unit of account to determine the basis of accounting thereafter. And the reason being, the characteristics of each of the asset and liability will vary from a market participant standpoint. So if it is a separate land to be sold, the way a market may perceive would be different from a set of assets which may go along with the land. So the values that may come up, the synergy or the value, the benefit that may come from a sale of a standalone asset vis-a-vis a group of assets could be different from a market standpoint. And hence the valuation correspondingly undergoes a change to that effect. And one of the other things that the standard also discusses is about the principal and the most advantageous, sorry, there is a typo here, market, I mean not meeting, my bad, principal stroke most advantageous market. So when they say principal market, it is, so from an entity standpoint, what is the market, the principal market in which it sells the product or this is available for sale, is the first priority that one needs to look into, to say that if there is a market which is generally in which it's purchased and sold, and then that is the market which needs to be the values that could come through from that market is what one needs to evaluate. If failing which, if there is no principal market available, or the principal market has certain restrictions, and then you look into a most advantageous market to say, from an entity standpoint, if they were to sell it in another advantageous market which is very advantageous to them, then what is it that the value can fetch? So the place where it is sold is also very relevant and important in the context of this whole determination of fair value. And similarly, the other aspect that one needs to bear in mind is in respect of non-financial assets. So the standard gives guidance in terms of how do you measure a non-financial asset? How do you do a fair value for non-financial asset? There could be items like buildings or land, which could be subject matter of an evaluation, could be an investment property. So all these non-financial assets, the standard says you will have to use the highest and the best usage. So there is a approach which the standard comes up with, say what is the highest and best use of this particular non-financial asset. Once you determine the highest and best use of this non-financial asset, then that could be the benchmark or basis for the value that can come through from that context. And we will spend a little bit time on that as we go along on both this principal and most advantageous market vis-a-vis non-financial asset. But these are some of the key terminologies or the considerations that as practitioners we should be mindful of as we embark on any of these fair value assessments. Then there are valuation techniques, which is again very important and fundamental in the context of how fair valuation is done. And this could be a combination of involving experts, valuation experts, and be it from the management's end, be it from the auditor's end, and evaluating these. And there is again adequate guidance in terms of how do one look into the different types of approaches that are available under the standard, and what is the hierarchy that from a fair value standpoint one needs to be evaluating. So these are again, we've got a couple of slides on these and I'll dwell on them a little more in detail. But these are primarily the 4 or 5 key aspects that one needs to look into in the context of evaluation. We can move to the next slide, please. So in a fair value measurement, as I said, it assumes that the principal market, the asset and liability is what one needs to look to. And principal market, as I said, is the greatest volume. So if you can stay on the early slide itself, sir. Yeah. So principal market is the market where the greatest volume and the level of activity for the asset is there. So different entities can have different principal markets as the axis, but one needs to, some markets may be restricted, some may not. So what is principal to that company or that entity is what you look into. And in the absence of a principal market, then you move to the most advantageous market. Is market where the maximizes the amount that would be received when it sells the asset. And so probably I'll elucidate that with an example so it is a little more clear. And if we go down to the next slide, sir. Well, this is a pretty busy slide, but if I'll just read it out as you all read it as well. If let's say there are 2 available markets for soya bean, export and domestic. So the export market is where there is a higher price available for the produce. But there are limitations volume because they cannot be sold beyond the limit. The government sets a limit for exports. So each producer needs to obtain an authorization to export its production. It's rare the government may authorize more than 25% of production for exports. On the contrary, domestic prices are lower in this market than in export market, but there are no restrictions in terms of volume. It's a free demand supply based market. And so other than the demand of the purchase. The producer intends to sell all the production that they can in the export market. When they do not have any further authorization, they sell the remaining in the domestic market. So in this case, if you were to see what is the principal market and what is the most advantageous market, although they intend to sell, because obviously that is the most advantageous market for them, export is the most advantageous market for them, and they intend to sell it in the export market. But given that there are absolutely no restrictions and there is only restrictions on demand and supply, and it's a free market. Domestic market is the principal market for the producers in terms of volume. So one should look at the fair value, which albeit maybe a lower realization, but that should be the market one needs to look into in determining the principal market. And in the absence of a principal market, or then one looks into the most advantageous market. In which case, the export here is the most advantageous market because fundamentally it gives a higher benefit to the producer, as because the exports are having a higher realization. So this is just to elucidate differentiation between principal market and advantage market, but one needs to apply this in case to case in the context of the type of assets that one is dealing with. Moving on to the next slide. This is again on the highest and best use of non-financial asset. So the non-financial asset is again, the standard has clear guidance in terms of how do you do a fair valuation of non-financial asset. These are typically based on the highest and best use from market participant perspective. So this market participant perspective is something that is a new concept for all of us, until the Ind AS came into play. Because the Ind AS just not looks at it from the entity standpoint in the case of a transaction like these, it also looks at it in any context of an impairment assessment or a fair value determination. There is a market participant approach which is suggested by these standards, because it says that you should also step into the shoes of a market participant who may buy or sell this product, and in turn look into the fair value from their standpoint as well as you determine the fair value. So that is something that one needs to look into, and this could be again on a standalone basis or maybe achieve a combination of other assets. So it is again dependent on whether it's sold as a single asset or a different asset, and it could be different for each of these scenarios. But there are certain limiting factors that one needs to look into, which is whether it is physically possible and legally permissible and financially viable. And what does this mean? So whether it is physically possible to sell these assets, I mean, is something that one needs to look into. Legally, again, are there any restrictions? Are there, let's say, if you have an agriculture land and you need to do a rezoning, or you need to kind of get an application to sell it so that it can become an industrial park. So is it legally permissible? I mean, then is there a restriction on those that needs to be considered? And financially viable. And after, let's say, you do all of this, whether there will be adequate returns in terms of cash generation from an investment perspective. So some of these three factors have to be mandatorily looked into in the context of determination of the fair value of the asset itself. So from a financial asset standpoint, the highest and best use is what is looked at from market participant standpoint. And in the standard also prescribes and says that, generally speaking, let's say if you have a land, which is being used in a particular way, the highest and best use should be evaluated from the use on its own. I mean, because by default, if it is a particular land or a building used in a particular way, you expect that even if you sell it, the interested party would want to buy it and use it in a similar manner, unless until there is a completely different potential for that whole area or an asset, which makes a person do certain modifications to arrive at a different usage. So by default, you look at the usage of the entity to say that this is probably the basis on which a potential buyer will also use it. And hence that is the primary start point. But that could, of course, get course corrected depending upon how, there are alternate basis of utilization and whether these are technically and feasibly possible. Moving on to the next slide, and we've got a bit of an example on that as well. So if you look into it, there are two examples, which is to say that a parcel of land, if it's used for farming, the best use is from farming. So typically, because when you expect the land to be used for farming purposes, you would expect that when sold, it will also be used for farming. So typically that should be the basis on which you should look into the highest and best use. But alternatively, if it is in market participant could consider an alternate useful land, if, for example, for commercial, but then all the other costs in terms of fair value should include what are the legal costs, viability analysis, traffic studies, rezoning, all of those become relevant in the context of determining, because all of this will go to reduce the fair value to an extent, because you would have to do all of this and say that for you to fair value is cost to sell, these are various costs that will be incurred, and typically then the fair value estimation may be different. But that again is function of how the potential usage could also end up being. But primary by default, the standard says you default to your own usage in terms of saying that if it is used for a particular manner, you expect that when you sold to another party, it will also be used in the same manner. But of course, you need to look into the variance thereafter. The second example, if you look at it, if the entity owns an investment property which comprises of land and an old warehouse, the land probably could be used for a different purpose, because if it's redeveloped, it has a very higher market value. But so when you look into the investment property and determine the fair value for disclosure purposes in the context of land and warehouse, whether you should use the current use or potential market value if the leisure park is redeveloped occurs. So typically speaking, the building per se warehouse, will be at zero, because there is in this context, there is no, the highest and best use is 0, because there is no other usage for the warehouse, because once if it's also being procured, it will be demolished and then a new property may come up. So in a way, when you do the disclosures, the value of the land may have a different value, but the building may have a completely different value. So that is something that one needs to look into from the highest and best use standpoint, because the best use of this warehouse is nothing but it is redundant in the context of the subsequent usage. So that these are some of the examples which kind of give you a sense in terms of how do you determine the fair value of a non-financial asset as well. If we move on to the next slide. So the financial assets are one aspect to it, but there are also the standards. Various standards also give expect that the financial liabilities and own equity instruments should also be fair value. And there are instances where financial liabilities are fair value, because you would, I'm sure all of you would have seen derivative liability. I mean, if there are transactions which are, liabilities which are pegged to an asset. So in a lot of times where you have an liability which derives its value from an asset, so then the fair value of an asset would mean that you could also fair value the liability. So the IFRS 9 has certain guidance in terms of when do you fair value a liability and a financial liability. And so typically some financial liabilities go through P&L, some financial liabilities go through other comprehensive income, any changes in the fair value. Similarly, own equity instruments, you may be wondering what they are. They could be on account of, let us say, business combination. Let's say if shares are being issued for an acquisition that has happened, typically then those, and if there are any contingent considerations, because there are certain consideration which is held back and will be paid on achievement of certain payouts later. So those could also become financial liabilities in the context of how do you account for them and fair value them at a later point in time. So those all would mean that you would also have an requirement to fair value financial liability. Although by default, most of the financial liability will be at cost. I mean, you would carry cost, but there could be very few items of financial liabilities which could be subject to a fair valuation in itself. And so the guiding principles are, if there is a value available for the instrument or the liability itself, go for it, use the price. And sometimes what could happen is that could be based on what if, let's say, there is a call option, from a option standpoint, you could still get a value, because the holder of the option would be able to derive value from that. So it could be from the own instrument. That is the first hierarchy that you probably look at. If that is not available, then look for an identical instrument. So if there is a derivative instrument where if there is a similar kind of instrument and there is a fair value available, use a quoted price. If not, then what you do is, then if there is a similar kind of instrument held by someone else, another party which is available from the market standpoint, then you go with that, use the fair value of that, and of course adjust for the volatility, the risk related factors in terms of another party holding it vis-a-vis your entity itself holding it. So these probably the valuation experts would be able to do a adjustment or a true up or a true down depending upon each company's risk profile and premium. So that could be one of the factors basis which you could arrive at the fair value. If that is also not available, then you will have to use appropriate techniques, which could be typically discounted cash flows. Those are types which you would look into, and where again you would need the experts and the valuation experts to look into. So financial assets as well as financial liabilities, measurement of those in fair value terms are governed by this particular standard, and this is one of the bases on which the liabilities get measured as well. If you can move on to the next slide, please. Yeah. So there is as I briefly mentioned in the earlier slides, there is a hierarchy in terms of how do you do a fair value measurement. It goes from bottom to top. The standard says that the best. I mean, because at the end of the day, fair value should be something that everyone should be able to kind of re-perform or be comfortable with in the context of how it is determined. So it is very important, because it's very subjective. It can be complex. It may be based on estimations, assumptions. So there are a lot of aspects that go in, determining the fair value, and hence, what is very clearly observable. What is very clearly observable is the most comfortable data point for everyone. I mean, so level one is where people start, because that's directly observable. So if, let us say, there is a financial asset, an investment in a share of a company, which is very highly traded in a stock exchange, then I mean, all of us will be able to spot that, the going rate, the prevailing rate, and then multiply with the number of shares held becomes a lot more easier and very observable for everyone. So it does not require a fair bit of, shall I say, it shall not be subject to fair bit of challenge. I mean, it is easily evidenceable and everyone and also identifiable. So that's the best option, and that's considered as level 1. So anything which is directly observable could be, could be one. I mean, I'm giving equity shares an example, but if there are anything else in a traded, in a traded platform or any other place where it is observable, then that's the best way to start with. So that is the first one that one looks into from a hierarchy standpoint. The next one is if you don't have that, let's say, for example, mutual funds. Typically, or it could be still equity shares, but then not highly traded. They may be listed in the stock exchange, but not traded actively. So those could also be still considered as level 2, but still because they are observable, but not necessarily a very direct reference point. And so it could also be, banks give mark-to-market rate, or which could be, in a forward contract which has been taken by companies. You do a mark-to-market at a particular balance sheet date. They could be determined either from Bloomberg rates, you could or the yields could be given, or the values could be given by the bankers themselves. So those are indirectly observable, but still they are a good indicator because you get it from an independent source. You are able to validate them. So those are level 2. Level 3 is where if you don't have any of these two, then what you are basically relying on is a reflection of management's view of let's say how a business will run. What are the future cash flow projections? What will be the growth rate? I mean, how will the business grow? How will a market participant look into it in the context of this business? So these are then fairly, your own assumptions factored for market participants' view. Then apply a discount rate, which could be based on the weighted average cost of capital, having regard to the risk premiums, which could be market adjusted as well. So all of those then become very fairly complex data driven by data provided by the management and assumptions driven by their own understanding and appreciation of market and their own business, which again requires as practitioners for us to audit them. So those are the ones which are fairly, shall I say, amongst the three difficult to audit or validate, and hence the standard setters have also rightfully kind of placed more, emphasis on relevant disclosures for each of this. So we will come to disclosures in a while, but at a very brief level, there are fair bit of disclosures for level 3 data, because wherever level 3s have been considered from a fair valuation standpoint, the standard expects that fair bit of data should be given to the reader of financial statements, because these are finally driven by the assumptions of the company in terms of their own growth rate, their own discount rates, which are again factored for market, but nevertheless it starts with the weighted average cost of the company. So a lot of other information needs to be provided as part of the disclosures in the financial statements, such that the reader of the financial statement is able to draw comfort or inference from what is the basis of such valuation. So we'll come to that in a while, but hierarchy wise, if you see any fair value measurement goes with this flow to say you look into a level 1, then a level 2, then level 3. So those are the basis on which this is done. If you move on to the next slide, in terms of valuation approaches in itself, you would see there are 3 types of approaches which the standard sets out. Standard talks about an income approach, a market approach, or a cost approach. Again, this is while there are 3 approaches, the fundamental theme that one needs to bear in mind is it is not like you actually keep, there is no hierarchy here in terms of saying you start with income approach, then go to market approach or to cost approach. What one needs to bear in mind is one needs to see what is most relevant or pertinent in respect of the class of asset or liability that is being subject to a fair valuation. What is the most appropriate method has to be used as opposed to defaulting to a particular method. So that becomes again a sense or area of judgment, and one needs to bear that in mind as they actually consider the valuation approaches. And briefly talking about these approaches, if you were to see income approach is again going back to your discounted cash flows, because what you are doing is you are actually taking the future projected income over a period of the 5 years, the explicit period, and then the terminal period for a perpetuity, or if it's for a set of periods because you're going to do an impairment for a particular period of time until it's held to be sold. then you determine based on and discount those cash flows. So these are basically cash flows are emanating out of those usage of those assets, and so that is why it is called as an income approach. A market approach is sometimes where there is a market multiple. So a lot of times you would have all seen and experienced that for a similar company in the same business, what is the multiple, PE multiple, what is the market multiple, and basis that then that is pegged to the companies and adjusted for the risk premium for the company to arrive at what could be the market value of the asset. So in terms of valuation, market multiple approach is another approach that companies follow to compare and benchmark and say, are the companies of same vintage and same pedigree and same size, or if not, it could be different size, but then adjusted for the size of the company, what could be the multiple, PE multiple, and then apply that on the value of the company to arrive at the overall value of the business. So that is a market approach that could be followed. The cost approach is typically where there is a replacement cost approach, or if you were to replace it, what is the cost that would be incurred is a basis on which it is fair value could be determined. So again, one needs to look into what are the observable inputs, whether how consistent is the application for a similar set of transaction if it were done in the past. If the company had followed an income approach in the past and wants to change it subsequently, are there reasons behind changing them and why they believe that change in method is appropriate? Some of those needs to be borne in mind in terms of determination of the evaluation approaches to be used. But as I said, it is it is again subjective and dependent upon case to case, on a case to case basis. So these are typically the approaches that one needs to bear in mind and look into to see where the evaluation itself fits. If you can move to the next slide. So moving on to disclosures, I mean, this looks pretty busy, but if you look into it, the standard expects the fair value hierarchy to be called out. So this is where if you see typically financial investments held through fair value through P&L, fair value through OCI, and then derivative instruments, be it again similarly from a financial liability standpoint, the forward contracts or contingent consideration, one needs to call out what is level 1, what is level 2, what is level 3. So how are things determined is again function of, so let's say if you have unquoted equity investment, obviously it is not traded in open market, so you will default to what is the future dividend earnout from that, or what are the future cash flows of the company, and then what would be the fair value based on the discounted cash flow method. So level 1, level 2, level 3 disclosures in the context of the financial assets and financial liabilities is required by the standard. So that is one that needs to be given. Moving on to the next slide, sir. And similarly, in the context of give disclosures on what is level 1, level 2, which is again we discussed in terms of how do you determine what is level 1, level 2, level 3. So this is typically a continuation of that. If you can move to the next slide, please. And in terms of where you probably also call out what are the kind of techniques that have been adopted, as I say, in terms of whether it is future cash flows or if it's in case of option contracts and option pricing models. So what are the methods that have been used in terms of that? And typically in terms of significant unobservable inputs, which are the ones which have been subject to a level 3, then you call that out separately as a movement. And if you can move to the next slide, sir, that will give a lot more clarity in terms of what are the expectations. So in a level 3, if you would see what are the significant unobservable inputs, which is like the earnings growth rate, risk-adjusted discount rate, expected cash flows, and also give a sensitivity, because the standard expects to say that if it were to move basis points plus or minus 50 basis points up and down, what will be the impact on the fair value. So that is again something that one needs to give. And again, the range. I mean, if it's a growth rate, you give a range. I mean, it could be a specific pointed. It could be a point estimate or a range estimate. But generally, you would see in especially at the advent of COVID, our institute has also given adequate guidance on this to say one looks into a range estimate in terms of some of this, given the this scenario that we are in and the challenges in terms of estimating a growth rate. So these are some of the aspects that one needs to specifically give in the context of level 3 investments, or where level 3 basis of valuation has been considered. If you can move to the next slide, sir. And it's a continuation of it to say what is the credit default rate. And again, if you see, there could be some commentary. I mean, these are illustrative. I mean, it need not be so verbose or in detail, but some in substances, all of this are to be given. I mean, in terms of how do you also explain, because the valuation process, if you explain more, it gives a lot more clarity in terms of, what is the rational basis which this has been done. So typically you will see compared to a level 1 or a level 2 disclosure, level 3 disclosures in basis of valuation requires fair amount of disclosures in any financial statements. We can move on to the next slide, sir. And this is again in respect of fair value of assets and liabilities. This is more from a disclosure because whatever is carried at cost and determined to be carried at cost, one has to also give the fair value disclosures to say that whatever is at cost. So let's say if you're carrying a corporate bond or a government bond at 5%, and today let us say the interest rates have dropped. So effectively your bond is at a premium because you are getting more value if you were to sell it off today. Given the fall in interest rates, there is a fair value will be higher than the carrying value today. So those would then require a measurement for disclosure. And similarly, it could be for any loans or security deposit, but generally some of them may mirror the cost. So in which case, then you don't do too much of change. But wherever there are changes, then those disclosures are required to be given as part of the disclosures in the standards. If we can move on, and I mean, just before while we are on the slide, just before getting into this, so just to summarize in the context of what we saw. Typically, the standard gives fair bit of guidance and extensive guidance, shall I say, in terms of what are the items of assets and liabilities where you could use the standard. What is the basis? What is fair value in itself? And then what are the factors that you consider from a fair valuation standpoint? Typically, the orderly transaction in a primary market or a principal market, and from a market participant standpoint, and in terms of looking at it to say that these are not in a distress sale kind of scenario, and then going to the hierarchy of fair valuation to say what is level 1, what is level 2, what is level 3, and also determining the approach to say is it a cost approach or an income approach or a market approach. And it also gives guidance for financial liabilities, where fair valuation of financial liabilities are required by the standards, other standards, and similarly for non-financial assets, be it land or building, which are or investment property, where investment property our Ind AS does not allow for fair valuation but requires disclosure of fair value. So in which case typically we don't follow a fair value model, but we only follow a cost model, but disclosures are required. So all of this would mean that the underlying standard for meeting the requirements of other standards would be driven from this standard. So, and then of course there are extensive disclosures in the context of once a fair valuation is done, what are the various disclosures that need to be brought out. So this sets out some of the challenges from an auditing consideration, and I thought I'll spend a bit on this as well, because this is again, as I said earlier, it's a very complex area. It requires a lot of judgments, estimates, and then it's not a, it's while one can say, I don't know whether one can say it's a science, although it is because two valuers may come with two different propositions. I mean, for the same asset. So it could again boil down to how one perceives a valuation in itself. And hence, given the as practitioners, and when we audit fair valuation, the things that we would look out for essentially is management competent to do a fair valuation on its own? Because there is nothing stopping management from doing it and seeking an external experts every time. But of course, then as practitioners, there is enough guidance from the institute in terms of use of experts. What is it that we need to look into? Their objectivity, their independence, their competency. So if it's an in-house expert, do they have the right set of people to do this? And how are they competent and how objective are they? Is there a bias, management bias that may creep in because of pressures of performance? All of those need to be then audited by us, and we gain comfort from whatever valuation that comes through. Alternatively, companies may not have the expertise in-house, and hence they may seek the support of external valuers. There again, the similar principles of looking into the competence, objectivity, independence comes into play, and also looking into their assumptions and basis in terms of how have they looked into it. Some of the things that we do look at, I mean, very clearly is management's assertion year on year. When we call look back analysis, what we do is, let's say the same asset has been subject to a fair valuation in the previous year. Management has given some growth projections. Then you would, with 1 year experience, one would know whether management has achieved those growth projections. If they said they'll grow at 8% and they've grown at only 2%, then is it, how reliable is the data? for the current year? I mean, are we comfortable with the data shared with them, or is the client very optimistic or the company very optimistic and hence given a best estimate as opposed to a conservative estimate? So those sensitivities in terms of the best estimate, the worst case scenario, best case scenario, the moderate case scenario, all of those needs to be looked into. Again, validation of assumptions. Assumptions, as I said, would be discount rates, because there is a weighted average cost of capital that kicks in. There is a growth rate. There is a perpetuity terminal growth rate. All of those are there. And there are these assumptions, working capital adjustments. There are a lot of assumptions that one makes in the context of building this up. So all of those needs to be looked into. And also very important is to know the industry in which the company operates. So if the company is projecting a growth rate of 8% and the industry is essentially not growing is degrowing or growing at a much lesser rate, what is the confidence of the company to say that they will grow at a higher rate than the industry benchmark? So some of these parameters also go as a way to validate whatever assumptions companies are making. Then the other one is the CAM. I mean, key audit matters are one which have come up in the context of listed companies, so to speak, specifically. And from that standpoint, one of the guiding principles which our institute has come up with also is to say that from a key audit matter standpoint, what is that area as an auditor we spend a lot of time on, which is the area which we take to the audit committee and discuss a lot, or to the board. So those are the ones then that needs to be reported. And generally speaking, these involve complexities, these involve assumptions, these involve spending of time, these involve using experts. So CAM would necessarily, if you see a lot of companies would have, auditors of companies would have come up with CAM in the context of valuation itself. And then last but not least, the representations from the management, appropriate levels of representation as part of the letter of representation to ensure that we get all of those also done. So from an auditing standpoint, if you look at it, there is fair bit of work that goes through in this whole process. And given that, one other thing that also we need to bear in mind is the controls in the process and the systems in place, because a lot of companies would be subject to IFC reporting, internal financial controls, and hence apart from looking into the valuation, we need to look into to see how is management having adequate control in the data that is being shared with the valuation experts. How are they comfortable with the sensitivity that they are drawing? Are they competent to make an assessment? And who at which level is this being reviewed? This whole computation is being reviewed from the management's end. So all of those also become very important in an IFC world where controls are also opined upon by practitioners like us. So that largely brings us to the end of Ind AS 113. And before I move on to the next topic, I can pause and then probably take questions if you think that's appropriate, or if you want me to continue with the next topic and then take queries thereafter, happy to do that.
You can see the chat box for the questions, sir, and if there's any, you can take it up.
Sure. Level 3 disclosure in the illustration mentioned is earnings growth rate factors are based on market information of similar type of companies. However, will a user reader of a financial statement understand what were similar type of companies considered? Please clear from various other which will be applicable to it, but how will transparency be established here? Please clarify. So surely, sir, I think if we can go back to the presentation, sir, if you don't mind, and just to the disclosures in itself. So typically, as I said, the market participant approach. I mean, if you can go back to the earlier slide, and the ones earlier to that, and one prior to that as well. You can move up a bit, sir. No, the one earlier to it. Yeah. So I think the next one, sir, just come down. Yeah. So effectively, the earnings growth rate. If you see, typically these earnings growth rates are. So effectively, in this instance, fundamentally, you start with the company's earnings growth rate. The earnings growth rate of the company, because these are typically discounted cash flows. What you would factor for here is to see from market participant standpoint is the industry benchmark in itself. To say that, as I said, if the industry is growing at a particular rate and the company expects to grow, let's say it could be depending upon which, what is the maturity of the company as well. A company which may be in a more mature state may not necessarily grow at a much higher growth rate than the industry. But if it's in a space where it's actually catching up, and then every year there is an opportunity to penetrate market, their percentages may be more than what the industry may project. So effectively, the earnings growth rate starts with the client's own growth rate, which the company actually looks into. And thereafter, then see whether that needs to be calibrated for anything from the market standpoint. But fundamentally, it would be the company's growth rate, because you are doing a cash generation of the company to say if whether cash generation of the company will be able to meet the carrying value of the asset as you do the fair valuation. So that's where it starts off with, and it gets factored in anyway. Otherwise, also what happens is when you do the weighted average cost of capital, it would anyway get factored for having regard to the beta factor, which could be the market. If you look into it, what is the median rate? I mean, it's just not the company specific cost of capital, but it's also for what will be the cost of capital for the companies in this particular industry. So there would be some factoring for that. So that would also calibrate the percentages accordingly. So either it could be calibrated here or there, and hence this would be factored in. But to your second point in terms of how transparent it would be, I think the expectation is not to call out. I mean, the standard does not stop any disclosures or does not say that there is a maximum cap on disclosures. So companies may not want to call out names to say which are the other comparables they've looked into, to say they've looked into their so XYZ company or ABC company. But they can in their own valuation approach, they can surely call out, and then a lot of companies do that, to say they have also benchmarked with their peers in terms of some of the growth factors or any other factors that needs to be adjusted. So to that extent, probably given the sensitivity of the overall scheme of things, people will be willing to share those or can share those. But to say that I mean, beyond that, I haven't at least seen people call out names to say I've compared this with XYZ company and ABC company. And over and above that, I think all of this are getting audited as well. I mean, the auditor is also spending a lot of time going through these disclosures and then validating those. So from a transparency standpoint or a trust standpoint, that's where our role comes in, to say that how are we as auditors also comfortable with some of these put out in the financial statements. I hope I've answered that question. Real estate assets must be stated at market value. So that is in terms of investment properties, sir. If they are investment properties as a standard, effectively investment property in our Ind AS does not allow a market approach. It only allows a cost approach. And when it means cost approach, it's not fair value. I mean, you cannot fair value them from an accounting standpoint, because from international IAS 40 standpoint, you could either follow a corporate cost approach or a revaluation approach, and you need to periodically revalue them. But in Indian context, India allows only cost approach. But nevertheless, the disclosures need to be given in terms of for investment properties, what is the fair value of those. That is the only case where the fair value disclosures are required. But failing which, you don't have that. In terms of other non-financial assets, from a land and building, you could still follow a market value approach, where they allow for a class of asset to do the fair valuation, which is the revaluation approach, in which case then the companies are expected to consistently follow. But precisely for real estate assets, there is, if it is only investment property you're referring to, that is not that's the only cost approach is required. Is fair value and fair market value the same? Income tax says fair market value. Sir, well, I'm not a very proficient person in income tax, but the aim is, I don't think it cannot be dramatically different, sir, because the fair value and fair market value as a principle, I would still think it's the same, but I don't know the specifics of what's fair market value from a definition standpoint for this. So actually let this pass, but I would still believe that it cannot be dramatically different in terms of how you determine, because it's more or less the same in the context of saying that you are actually, pegging a value for a transaction with an unrelated buyer and a seller. If we use level one company in the same industry for reference while doing fair valuation, should we make adjustment in the value or just consider comparable company numbers? So level one would be typically, sir, for the same company, would not be a directly observable input. I mean, in the sense, if I can understand it better, if you're, let's say, referring to a share, then you have it quoted in the market. But if it is other than that, I mean, if it's more an identical asset, then you will probably have to do the adjustment, because technically speaking, each company has its own risk premium, and there could be aspects relating to that. So those adjustments have to be made. Then in which case, then it is not necessarily a directly observable input. Then it becomes more like a level 2, because it is not very direct, because you're doing certain adjustments for your own purpose, which again is a subject matter of valuation. And so it will, but you could do that adjustment. If there's near identical asset available, then you do that and adjust it. Then you probably have to disclose it. But only question is whether it will be level 1 or level 2 is only the point that you need to point. Can goodwill staying in merger be treated as transaction cost and written off? Goodwill arising in merger. No, sir. Goodwill is determined. It is not necessarily, it is not covered in the standard, but effectively it is covered under Ind AS 103, the business combination standard. And goodwill is a separate asset in itself, because what happens is the standard 103 explains very clearly how do you actually go about accounting for the purchase consideration vis-a-vis the assets and liabilities taken over. And as all of us know, the net resultant is a goodwill after identifying all assets and liabilities, be it on balance sheet or off balance sheet. So goodwill will not be a transaction cost. It is a separate asset in itself and has to stay on the balance sheet. Transaction cost could be any cost that you incur, like a diligence cost or an advisor cost, and all of those would be the cost that would kick in there. Whether fair valuation by external agency is necessary in respect of PP, or if management assumes enough and management assumes no impairment can. So here again, sir, it again depends on the, as I said, what is the complexity of the asset that you're looking at and how competent is the management. Because as an auditor, you need to be comfortable that the management has the right level of skill set and is competent and objective to do this assessment. And if they have the, let's say they have the technical engineers who are competent and they are certified, they have an accreditation in terms of educational background, and they are able to come up with a valuation which is competent, then one could look into that. There is no hard and fast rule that you need to look only at external experts, but as an auditor, you need to be comfortable, and mere management representation alone will not suffice, because this is again a very complex area, requires fair amount of, which is not in our domain as practitioners. We don't necessarily, we are not competent to, consider this from our own standpoint. So it would, I would assume management representation is an essential part of it, but it's not the only aspect that would give you comfort. It has to be more than that in the context of looking into validating the assumptions itself. So those are the questions that I can see on the chat box. If there aren't any more, should we take a 5-minute break if you want before we get into the next topic, sir? Or how do you?
No, you ask your prefer. If you want 5 minutes, we'll have a break.
I leave it to you, sir. I mean, I'm okay, but I just thought 1 hour. So if it's a bio break or anything else.
Yeah, we'll now time is 8:30. We'll resume again at 8:35 or something. 8:33, 2 or 3 minutes, 5 minutes break. We'll resume at 8:35. We'll do, sir.
Sure. Okay.
Break, yeah.
Sure, sir.
We'll put a message in chat box and we'll resume at 8:35. Yeah.
Okay. Thank you.
Sir, can we resume our sessions? May I start sharing the screen, sir?
Sure, please. Yeah.
So is it visible?
Yeah, it is. It's specific. Should we start?
Yes, we can start here.
Sure. Okay. So the next topic for the day is Ind AS 19 Employee Benefit Standard. I mean, this is something that we've been used to for a large extent. From even our AS 15 standpoint, this is one standard where there has not been much of change since what we've been used to for a period of time. So there are very limited aspects which have undergone a change, but other than that, largely it is more or less the same. But it's probably useful to just go through that in the context of what are getting covered under employee benefits. We'll move on to the next slide, sir. So typically, as you see, the employee benefits include long-term employee benefits, short-term employee benefits, terminal benefits, and post-employment benefits. So all these four types of benefits, employee benefits, are the ones which are governed by the standard. And each of this has their own accounting treatments and relevant disclosures that kicks in. And we will probably go through each of this in the context of what they mean and what is the underlying accounting treatment as well as prescribed by the standard. Next slide. Yeah. So if you see what is getting covered under the standard. So any formal plan or agreement. So there are various plans which are between an employee and an employer, an entity. So if there are any formal plans which are there or agreements which are there, those would get covered. Legislative requirements or industries in which they operate. It could be like your PF, ESI, or gratuity, payment of bonus. All of those which are legislatively required, those could come in. Any informal practice. So there is a concept called constructive obligation, which is even very limitedly used in our erstwhile Indian GAAP, or the Indian GAAP is used for other than companies which apply Ind AS. Constructive obligation as a concept. So you will all be aware of a contractual obligation or a legal obligation. But what is constructive obligation is if by virtue of any practice, or by virtue of any announcement, if there is a valid expectation set in the mind of any person, including an employee, then that is something that the company has to then make good of. So conventionally, if there is a practice to give away certain bonuses year on year, and that is a conventional practice, and that's set in the mind of an employee to say that every year company gives an additional bonus over and above what is required by law. And that is something which could be a festival advance, festival bonus, or anything which could be a convention, or an annual day bonus, anything that has been set out and that is well entrenched in their practice, working day practice. Then to expect that on a year-on-year basis is a constructive obligation, because then the company has a constructive obligation, because otherwise it would it has been a valid expectation has been set in the minds of the employees, and hence that is something that the company will honor. So to the extent that could be an obligation that one needs to look into, and then if there are any such obligations, those need to be provided in consideration of the standard. And any informal practices, again, which could kick in as well in that sense, which need not, I mean, both they have realistic alternative, but I mean, it's more an expansion of that to say that what it is and what is not applicable is 102 standards on share-based payments. Although these are again for employees, there could be stock options given to employees, shares being given to employees in purchase plans, but those are governed by another standard, and hence that standard will cover whatever is the accounting and disclosures for those. Move on to the next slide. Yeah. So what is short-term employee benefits? Short-term employee benefits, as it says, as nature is anything which will be settled within 12 months. And their expenses are accrued and are accounted on an accrual basis. And typically you would see that regular ones that fit into this would be your salaries, wages, bonus, social security contribution, paid leaves, medical insurance, subsidized goods, which companies may give, company car, accommodation. All of those that get settled in 12 months time, as and when that's incurred, those are short-term employee benefits. And employee benefits, again, those could be accumulated compensated absence. I mean, when there are short-term employee benefits, there are compensated absences. So we are all used to, I mean, this is a term which is also there in AS 15, which earlier people used to look into, if all of us, just to refresh, leave encashments. Only encashed benefits were accounted for until AS 15 came into play. Then revised AS 15, I would say. Then they broadened the concept to say there is a compensated absence, which means that it is just not what is paid as leave encashment at the time of settlement or at the end of the year if anything is unutilized, but also what could be carried forward and utilized as a paid holiday. Those are also typically an compensated absence, which could be accrued for because they are received by virtue of servicing the company in the current year. So then there is an accrual that is required for those services, those compensated absence, which can be carried forward. So that is where it is accumulated. There is the difference between accumulated compensated absence and non-accumulating. Accumulated means which while the employee is rendered service in the year, and he or she is entitled to, let's say, 21 days of earned leave. And if he or she does not utilize the entire 21 days in the current year and can carry forward for 1 more year or 2 more years, the entire 21, whatever is the balance left, those are typically one needs to accrue for them as an expense because they will be utilized in the subsequent year by the employee, and they will get a paid leave, which means then there is a payout to that extent. So that needs to be accrued now, and hence that is something depending upon whether it is short term, whether it will be settled in the next 1 year, or if it can be long term, if it can be carried forward for more than 1 year. So various companies have various policies to say that if you don't carry it forward, you can carry it forward to 1 year, and after the 1 year it will all lapse, or you may get paid. Or some people may say, no, I will carry it forward for 5 years, after which it gets lapsed or it gets paid depending upon the policy. So if it's more than 1 year, then you go with an actuarial valuation because there is an element of assumptions involved. If it's less than 1 year, then there is not much of discounting required, and hence so a company themselves can carry a risk. Non-accumulating composite absence is basically as and when they happen, they you account for it. Typically like a maternity benefit, if it's available. As and when it happens, then you expend it and you don't accrue for it in anticipation of it. So these are typically the terminologies used from a compensated absence standpoint, and those needs to be factored in the context of document. We can go to the next slide. This is just an example. I just did give a brief example on compensated absence. So in this case, A Limited has 100 employees. Each is entitled to 5 working days of paid sick leave for each year, and the unused sick leave carried forward for 1 more year. So sick leave is taken on a leave for basis. So basically, they take the leave of the current year, and then if they use everything of the current year, then the previous year balance is utilized. So as of December 31, the average unused entitlement is 2 days per employee. A Limited expects that in the next year, based on the past experience, 92 employees out of 100 will take only 5 or less days in 2009, and which means the next year, the remaining 8 employees will take 6.5 days. So what will be, so if there are 100 employees with 2 days per leave, so 200 days of leave can be carried forward at the end of December 2008. And now we are saying out of that, whether this 200 days of leave needs to be accrued for or how much needs to be accrued. But if you see the past trend, people take less than 5 days. So which means since it can be carried forward for only 1 year, at the end of next year, this will lapse because 92 people will not take more than 5 days. And the first on leave for basis, that year entitlement is first taken, and then only over and above that, you would be entitled to carry forward from the earlier year, which means then the carry forward benefit is lost because 92 employees will take less than 5 days. And so whatever is there from 2008, they will not be entitled. However, there are 8 employees who take 6.5 days, which means 5 days of the current year, 2009, they will utilize, and they will pull back or use 1.5 days from the previous year. So from an accounting standpoint, company, when they close the books on 2008, they will have to take 1.5 days into 8 employees. So then what is per day leave is basically cost to the company, CTC, average CTC for 1 day into 1.5 days is what they take, because 1.5 days of current year's leave will be carried forward to subsequent year and utilized. Balance all will lapse, so there is no obligation on the company. So this is compensated absence as a concept, which is different from the leave encashment that all of us were used to, because if you are paid leave, then only those were accrued in the past before the AS 15 revise came. So this is not any different from AS 15 revise in that sense. And so to the extent it's similar, but just to illustrate the concept, this example is brought up. Moving on to the next slide. The concepts of defined contribution plan and defined benefit plans are, as we are used to, are pretty much the same. So from a defined contribution plan, typically we would know any contribution to a regional provident fund would be a defined contribution plan, for the simple reason that once the contribution is made, the company has no further obligation. It is the employees have made a 12% of contribution on basic salary, and employer contributions have been remitted to the regional provident fund. Thereafter, for that month, there is no further obligation from the company standpoint. So these are typically the ones where it is just limited, the obligations limited to the contribution. The risk is with the employee. Typically, given that regional provident funds are sovereign, so I mean, it may be relevant, but from a concept standpoint, the employer does not have any obligation. Any further changes, there is no discounting required because these are monthly payouts, so there is nothing that will be adjusted in the future. So to the extent it's done, and they are accounted as and when pay as you go, they are accounted in that sense. On a monthly basis, they are accrued and then accounted for. Any unpaid portion obviously will be paid subsequently. You create a liability depending upon the period. But on the contrary, a defined benefit plan is where you have agreed to a benefit in future. So it is based on, let's say, a gratuity. It is based on last drawn salary at the time of separation of the employee. And sitting today, if one knows that this employee will be there for 5 years, or already the person is already there with the company for more than 5 years, and you have an obligation as a company to make a payment as and when the company leaves, there are a lot of forecasting that is required or assumptions required. To say that what could be the potential salary at that point in time, what is the period by which that person may retire or leave the organization. That's all based on the trends of the company. So an IT company may have a higher attrition than a brick and mortar company or a service company. There could be a lot of industry-wise, the attrition rates could be different. So depending upon the company and the industry they operate and their own company's fact pattern, they will know what is the expected life of a person in an organization, and actually will be able to do that based on the date of joining to the date of separation. Based on past trend, they may say an average life of an employee in an organization is 5 years or 10 years. So depending on that, the actuary would then determine what is the projected liability, and this gets updated on a yearly basis. So the obligation or the risk is still with the company. It is not to say that I project something today and then this is cast in stone. It is not, because things may change, because the salary definition may undergo change, or the discount rate may undergo change, or the other if they are going to make an investment in LIC based on this, the plan assets may have a different rate of return than what is expected. So all of this may mean that the liability may keep going up or down until finally it is settled. And so these are typically called as defined benefit plans, and then hence the employer still has an obligation, and this is determined based on the actual valuation if it's a long-term benefit in nature. And there are steps to do. So there is a very broad differentiation between a defined contribution where once amount is paid, there is no obligation thereafter. But a defined benefit, you can either approve it. A lot of companies keep it in their own books as approval without having a corresponding investment with an LIC or an insurer. On the contrary, some of them will have a investment with an LIC or another insurer to say that they will maintain fund balances there so that the discharge happens out of the fund balance, and the trust will administer the discharge. So those are the broad differences between a defined benefit and a defined contribution. Move on to the next slide, sir, please. So if you look into it, typically the recognition measurement of defined benefit plan, as I said, is complex because of the following reason. Because these are future benefits. They are not typically measured today. So you would not know with a very clear, fix that when a person will quit, when a person will retire. Of course, retirement at least to an extent is possible, provided they stay on for that course of time. And what is the impact of present value? Because the discount rates may keep changing, and there are other assumptions to be used, which could be the mortality rate, which could be the growth rate of the salary growth rate, and then could also include the attrition rate of the company. So there are other underlying assumptions basis which this number keeps changing and never remains static. And so this becomes complex in itself. So these are the inherent challenges that one needs to look out for. And we can move on to the next slide. So some of the actuarial assumptions. So these are the what I spoke about. Be the mortality, employee turnover, early retirement, claim rates, discount rate. All of these are determined to they are broadly called as actuarial assumptions, because these are all the assumptions which an actuary will factor in based on either data provided by the company, or some of them could be based on data available from the open market. And so accordingly, these are broken into two parts. One is a demographic assumption, which is nothing but to do with the people, which is the mortality, turnover, claim rates, etc. Financial assumptions are basically the discount rate, future salary rates, return on investment. So these are again assumptions which have a financial connotation. So these are broadly the two types of actual assumptions. And now moving on to the 4 steps. So the 4-step method is to basically, by following that, and we can drill down further. So this, the step 1 is to determine the surplus or the deficit. So typically the standard gives you the guidance in terms of saying all of this assumption, actual valuation should be done on a projected unit credit method. So there is a method which the actuary would follow to say that, on a projected unit credit method, what is the, future liability which will come through in the context of obligations for the current set of employees. They would describe that obligation based on the present value and arrive at the current service cost. Then from that, whatever is the obligation so determined, whatever investments that the company has made so far with LIC or any other insurer will be reduced to arrive at the net liability. So if there is a liability that they determine to be 100 rupees and there is already contributions made to a trust or a fund which is 75 rupees, the net liability which will be disclosed as an obligation will be, present value of that will be 25 rupees. So that again is then, and that could be either a deficit, or you could have, as a company, could have made excess contribution. Let's say they made 110 rupees of contribution, you would have excess of asset over a liability. But the standard also gives you a basis to measure the net asset, which is gross. If the net asset benefit is there, then the standard says it should be factored for how will that asset be utilized. Is there a curtailment in utilization? Is there a restriction in utilization of the asset? Because sometimes what may happen is you may not be able to get the refund because this is to a trust, and so the company may not get the refund. It can be used only for the benefit of employees. So if, let's say, if all employees were to be paid off for a period of time and still a surplus is left, will that amount come to the company or not? And hence that has to be curtailed to that extent. Could also be to the extent of what will be the future liability which can be offset by this, because now I've already paid so much, so I can offset my future contributions to the extent, and so is there a reduction in my contribution in future? So the standard says you have to determine all of those and arrive at whether there will be any reduction in the net asset value. So that is the step 2 that one needs to follow. Moving on to the next slide, sir, which will be the step 3. Is to say what will then be determined to P&L, because you would have an opening liability and then there is a movement in the current year, which is the current service cost, current interest cost, and past service cost. Sorry. So all of those goes through P&L, and I'll come in a while in terms of what will also go through OCA, which is the step 4. So as all of us know, Ind AS, the statement of profit and loss account, which is called as the total comprehensive income, is broken down into statement of profit and loss account and other comprehensive income, and then totally combined as total comprehensive income, which means there are certain portions of changes in fair value of assets and liabilities would go through the other comprehensive income and not be routed through the P&L. And there are enough guidance around it on various standards around it. And one such standard is the employee benefit standard, which says that any changes on account of actuarial assumptions, which is the actual gains or losses, returns on plan asset, the ceiling which I spoke about earlier, all of this should go through the OCA. And only the service cost, which is nothing but to say by virtue of passage of one more year, the person has spent one more year, and hence there is a cost which comes in because the person has been with them for 4 years, now he or she has gone for 5 years, and so there is a service related cost, there is an interest cost because there will be an unwinding of discount rate. You would have taken time value of money for 4 years, now it is 3 years. So that 1 year unwinding charge is an interest cost,
and any past service cost. So because what can happen is, let's say, for example, I mean, when the gratuity rates underwent a change, I mean to say that ceiling rates went from 10 lakhs to 20 lakhs in terms of income tax. So there were some changes to plan because of the requirements of law, or you could also in your own agreements, some companies may say that I will give you 15 days salary, so that they may say 30 days salary, last month's salary into 15 by 26, instead of they may say I will give you 1 month's salary. So there are companies which are given over and above what is required by law. So if there are any changes to plan that they make, so those may mean that there will be a catch-up cost, because for all the services that have been rendered till date by employees and brokers, all of those there will be a one-time cost that may come in, because for all those years also you are calibrating. And so those are past service costs typically, and that could be a gain or a loss depending upon how it goes. So those go through the P&L. What goes through the OCI is basically, let us say discount rate was 8.5% last year, and now it has come down to 8.3%. And so the difference on account of exchange, discount rate will then go through as an actual assumption. So that will go through OCI. Similarly, the attrition rate was 12% given to the actuary of company employees. Now it has gone up to 15%, because of which there is a reduction in liability. And so then that gain or loss will also go through OCI. And similarly, if plan asset, LIC or any other insurer plan, the expected rate of return was, let's say, 8.5%. It's come down to 8%. Because of that, obviously, there is a reduction in your plan asset value. So those go through your OCI. So all of this that goes through OCI, at the end will get finally, will not get flushed back to the P&L, because there are guidances in various standards to say certain types of fair value changes which are in OCI, when the final settlement happens, will go through the P&L. But then there are certain sets of guidances in terms of standards like these, where they say any changes on account of this, finally when it becomes zero, let's say at some point in time, all of this will directly go to equity. They will not be routed through the P&L. So this is one such type of guidance where, or accounting treatment, where nothing goes back to P&L on account of this purpose. Everything will go back to equity. So these are the 4 steps that one follows, which is nothing but define a liability first, see whether there is any cap or ceiling if it's a net asset scenario, determine first one, you determine liability, now also determine what is the P&L charge or P&L gain reduction, and similarly what should go to OCI. So these are the 4 steps that one needs to do as far as the defined benefit obligations are concerned. Moving on to the next slide, sir. Plan assets. So as I said, plan assets could be largely, and this is, I mean, there are 2 types of, just to give you an example, there could be a gratuity related obligation. Some companies, I'm sure one of us might have seen, some companies do not consider contribute PF to regional provident fund. A lot of companies have their own trust, PF trust. So the standard says that if you have your own PF trust, then to the extent of, because what happens is the standard, be it in the AS 15 or in the Ind AS standard, says that to the extent of the minimum guaranteed return, because the PF authorities expect a minimum guaranteed return to be set for any trust, which is actually a own trust as well, which cannot be lower than what the regional provident fund may provide as an interest. So to retain the value, what may happen is, to that extent, that can undergo change, because depending upon the interest rate changes over a period of time. So to that extent, the standard has said that the actuarial risk or the investment risk lies with the company. So tomorrow something happens, let's say that because of the change in rates, that there is a fall in the value of plan assets, the employer is expected to contribute more money into the trust and make good the payment to the employee. And so to that extent, those trusts could become actuarially valued. So you would see some disclosures on actuarial valuation for those PF trusts, and any changes to those go to the OCI. But otherwise, plan assets are typically the assets which are either, so in those cases, the own trust, there are certain guidances, because there are regulations under the law which says how much can be in corporate bonds, how much can be in sovereign bonds, how much can be in risk-free investments, and how much can be in shares or in equity market. So there, if a company administers its own trust and runs it, then they have a policy to follow. And if alternatively, if they give it to an insurer managed fund, which is like an LIC or any other private insurer, there could be basis on which they do. And so you, as companies, would get the fair value of the plan asset. So the standard expects that those plan assets should also be fair value. And again, it will mean that, let's say if you have a corporate bond, there are bonds or government bonds. Then based on the ratings of various credit rating agencies, it could be a A-rated bond, B, double A, A plus, or even a D-rated bond or C-rated bond or BB plus, whatever it is. If it is D-rated, obviously it may have to be brought down in value. But if it is BB plus or A plus, again it depends on that. There would be valuations available. So if it comes from LIC or any other insurer, they may themselves do that and provide the assessment in terms of fair value. But if it's a company-owned trust, then the company has to, or the trustees of the trust will have to, the trust management will have to do the fair valuation and give the fair value of the plan assets, which then is compared with the obligation which the actuary determines. And so, to the extent, the plan asset should always be subject to a fair valuation. So that is one of the key factors that one needs to look out for. We'll move on to the next slide, sir. So if you see the components, as I said, just to reiterate, service cost will go through P&L, which is your past service cost, current service cost, any gains or loss on settlement, if there's any settlement of the plan, net interest cost, which is again the unwinding of 1 year by virtue of the discounting. So those will go through the P&L. What will go through OCA, and as I said, will not be reclassified to P&L, is any changes on effect of ceiling, we spoke, return on plan assets, and actual gains or losses. So these are the ones that you will see in a lot of the balance sheets that we audit. We would see companies having put those through the OCA, and these are then reclassified directly into the equity. Finally, yeah. So moving on to the next slide, I'll come to the questions a little bit later. So moving on to the next one is the discount rate. So again, there are prescriptive guidance in terms of discount rate. So this is once a change in terms of difference between IFRS standard IAS 19 and Ind AS 19. Our standard expects us to look into the government bond rate, GSEC rates for market yields. And whereas IFRS does not say specifically corporate bond or government bond rates, it says high quality bond rates, high quality corporate bonds, which is in point 3. And I'll come to it in a bit. But our standard expects us to look into government bond rates and GSEC rates. And this again has to be coterminous with the period. So let us say if we know that the average life of employees in an organization, when I mean life of the employees, is the staying retention of those employees, let's say they would be there for other 10 years. I mean, at an average, if you do the computation and see based on that, then the company should take 10-year bond rate, because these obligations will be discharged over the period of 10 years. So the companies will take the GSEC rates which are available in FIMDA or Bloomberg and say do an interpolation. If it's not exactly matching, it could be, let's say, 11 years and you have a 10-year bond and a 12-year bond, then you do an interpolation to say what could be a 11-year bond rate. And that bond rate is what will be considered for the purpose of discounting. And similarly, it should be in the same currency as what is denominated. And if it's in India, typically it will be in INR. Then if, let's say, companies have outbound subsidiaries, they have investments abroad, there typically what they say is, you should take deep market high quality bond. So if it's an actively traded corporate bond in those jurisdictions, let's say a company has a subsidiary in Australia or in UK, then whatever is the high quality corporate bond rates are actually traded there, that is what should be considered. And if that is not available, then go for the equivalent government bond rates there. So as I said, maturity of the bond should be consistent with maturity of the different obligations. So that is very important. You cannot take a bond rate which is, let's say, for 3 years when you know that the obligation, when you compute it to say average life of an employee in a company is, let's say, 10 years, you can't say we'll take 3-year bond rate and discount it on a 10-year liability. So it has to be the 10-year bond rate, which should be discounting the 10-year obligation. And single weighted average discount rate is, let's say you have different plants and effectively there, then you can take a single weighted average, is what the standard says. So this is basically on the discount rate, which is a very important factor which can be audited. So a lot of times what happens is, this can be audited, although a lot of times it is provided by the actuary. As an auditor or a practitioner, we can re-perform this by looking into the Bloomberg rates or the FIMDA website and seeing what is the rate, because the average life of an employee in an organization will be provided in the actuarial report itself based on data provided to the management, which again is historical data, can be audited by us, because if you plot the date of joining, date of leaving in the past, and you will know what is the average trend of employees and what is the staying retention capacity of the company, retaining capacity of the company, and that could be re-performed as well. So these data will all be available with us, because most of the time the actuaries would insist for data from the company before defaulting to any industry benchmark. If let's say companies in ICAI, if they first they will ask for the company in the ICAI, that company's data on all of these parameters, and let's say for some reason it's not available or the data is not very clear because patterns are not consistent, then they may take the industry ratios for the. So all of this can be audited by us. Moving on to the next slide, sir. So once you remeasure, these are the things that you look into. I did speak about it to say that these happen on a year-on-year basis. While you do this, you continue to do the same thing year-on-year, which is like actual gains or losses, return on plan assets, changes on ceiling, and year-on-year you take a look at it and then account for it. And this is how it continues on a yearly basis. You can move to the next slide. So that brings us to the next topic, which is termination benefits. But typically, at a very broad level, if you see, these are the two big aspects we look at. There are other long-term benefits as well, and we'll come to that in a while. But if you look into, there is a defined contribution plan, there is a defined benefit plan, which is what most of us would see in our own audits, and as we look into it from a company standpoint, because all these plans will fit in, and they typically then can get bracketed into a short-term benefit or a long-term benefit. So anything which will be settled within 12 months time is a short-term benefit. Anything which takes over a period of time, like a gratuity, which is long-term, because predict whether all employees will retire next year, because very unlikely that the company will liquidate or close everything next year, and so it's on a going concern. So that could be a long-term plan. So defined contribution, defined benefit, broken down to short-term, long-term. And again, a defined contribution is more where the obligations are typically fulfilled as and when you make the payment, as when you accrue for it, no further obligation. Defined obligation is a continuous journey which is settled until it is settled. You will have the company take its ownership, and this could include the things statutory like a leave and gratuity, or it could be like compensated absence, which I spoke about, depending upon the company's policy, whether it is long-term or short-term. Termination benefits are something which is over and above what employees on their own leave. What employees who resign are not necessarily covered in this termination benefits, because these are ones where the company decides to terminate employee for whatever reason, or let's say a voluntary retirement scheme is run by this company, and the company's offer has been accepted by the employees, and so then there is an obligation that are. So typically this is again determined based on, so a lot of times you see VRS schemes coming in, and so when do you, because there will be a time phase, there will be a plan, there will be a plan which the board will be taking into cognizance, a scheme will be announced to the employees, and then there will be an offer period to say within next 1 month, if people whomsoever is willing to take up this offer, you will have to assent to this offer, give a consented writing, and then typically based on that you would know that this is crystallized. So what would happen is just merely rolling out the plan is one part of it, but it becomes a bit tricky, because unless and until there is a past trend and we know that for a fact that every employee will take this plan and there is a clear message that these employees will go with it, then the liability does not kick in just because mere mention of a plan. It has to be little more clearer to say that when they cannot no longer withdraw the offer, where people have also, they've given a plan and the plan is complete. I mean, now you can't withdraw the plan. The plan is for, let's say, runs for a month of time, and after the month, obviously the plan cannot be withdrawn, the benefits cannot be withdrawn. So then you know for a fact that whomsoever has opted for the plan, you have to approve. And again, there is an interplay of Ind AS 37, which is the liabilities, contingent liability standard, where there is restructuring happening. And so you look into either of the earlier of these two, and then say that by now you can't withdraw this plan. There is an obligation that's clearly on the company, and hence approval happens. So this is again guidance in respect of VRS schemes as to when this needs to be approved, and mere mention of this in a board resolution. Sometimes what happens, company may pass a board resolution, but they may not even have announced it to the employees, in which case there is no obligation at all, because there is no anticipation, no expectation that someone will take it up. And so you will have to see at what stage of the cycle is this whole plan of VRS, and hence this termination benefit approval kicks in accordingly. So that is one other area which comes into this employee benefit standard, and that needs to be clear. We can move on to the next slide. So the other long-term benefits, as I said, could be things like long-term disability plans. Some of these are profit sharing or bonus plans, or long-term paid absence plans. Again, these are plans which are different in nature, but not necessarily seen to a large extent in many organizations. Although sabbatical leaves have started kicking in now, many companies are giving those as options. But it is not any different, because it still goes through the same principle to say if it's more than 12 months, whether an actual assumption is required. Because sometimes if it's not very complex and it requires only certain things like, let's say, a forfeiture rate, I mean, you have a past trend to say that, I know how many of leave will lapse. And if it's not very complex, then an actual valuation may not be required. But more often than not, you would see the company is deferring to a defaulting to actual valuation because there may be too many variables involved in terms of growth rates, salary change, salary rates, escalation rates, employee utilization, leave utilization rates, and others. And hence, other long-term benefits also will go through the same thing, but then again broken into service costs, interest costs, and remeasurement goes through OCA. So that is again another angle to it. But these are the four buckets. I mean, you see defined contribution, defined benefit, termination benefit, and other long-term benefits. We move on to the next slide. So then disclosures again. See, these are again extensive disclosures which are prescribed by the standard. As you would see in a gratuity, which is a defined benefit obligation, present value of obligations, fair value of plan assets, movement between those from the beginning to end in terms of remeasurements, what are the return on plan assets, what is gain or loss on demographic assumption, financial assumptions, etc., the actual assumption, and experience losses. So when you see the one other thing that comes into your actual assumptions is experience adjustment. So there are three parts to it. Although I mentioned about the two assumptions, but if you see there are three parts to it in terms of say there is a demographic assumption and a financial assumption, which are part of the actual assumptions, and there is an experience adjustment. Experience adjustment is because 1 year has gone by. Last year you had anticipated that there will be 5% increase in salary, but then 6% was actually the reality. And so for the last 1 year, there is an experience adjustment which will come in. So anything for future, similarly that we may project will go as other assumption, which is, it could be a financial assumption or actual assumption. But experience adjustment is for the year that has gone by, what has been your experience vis-a-vis what you projected last year. So that will be captured. So all of this will be provided by the actuary themselves. So these are the ones that generally form part of the actual assumptions. So this is one disclosure in terms of the movement in present value of obligation and fair value of plan assets. Moving on to the next slide, sir. Again, it's a bit tiny, but again, you give depending upon which location, because if companies have multiple subsidiaries or other operation, each of this plan has to be given for each of those entities or types of plans that they have, even they have branch elsewhere. And similarly, the significant assumptions. So if you see there is a discount rate assumption, inflation rate, salary growth rate, pension growth rate, if there's any, mortality rate, claim rates for medical exemptions. So all of this needs to be given in terms of mandatorily to say what are the assumptions that have been factored in year on year. We'll move on to the next slide. And sensitivity. These are things which these actually themselves will prepare and give. If you see, if in many of your companies which they provide the assumptions and the actual report, if these are not forming part of it, you can always, as practitioners, go back to the company and tell them that these are required, and they actually will give them. So actually will give, saying that if any of these assumptions undergo change, what is the basis points by which the liability will undergo change? So they will do a sensitivity analysis and give. So if there's a 0.5% increase in your discount rate or a decrease in discount rate, how will the liability look like? Again, similarly, each of these assumptions, you get a sensitivity done, and that is given by the actuary as part of disclosure. Go to the next slide. The other disclosures are again in terms of plan assets. So plan assets, sometimes if it's insurer managed funds, then we just say that insurer managed funds 100%. But if let's say there is a own trust, and the trust is made in different instruments, it could be an equity instrument. So all of those then need to be given in terms of how much is in cash equivalent, equity, debt, etc. So that is another disclosure of plan assets. You can move to the next slide, sir. Risk exposure. So this again, you don't need to be so verbose, but you can give typically what are the factors that have been included: asset volatility, change in bond rates, inflation risk, life expectancy. You can move to the next one. This is more exhaustive, but it's not very accurate in that fashion. And this is for employer contribution itself. Wherever this is again a sensitivity they would give. So if you see there is an expected contribution, typically to say expected contribution in terms of just give me a minute. I just thought I will spotlight the area, but I'm not able to move my cursor. So expected contribution, if you see in the third paragraph, what is the expected contribution next year? So that again will be provided by the actuary. Yes, thank you, sir. And then the weighted average duration of the benefit. So which is what I said. What is the weighted average obligation? 27 years. So 27 years bond is what then you look into. So this is again something that actually will give in his or her report. And then the payment, undiscounted cash flows. So the undiscounted cash flows which are going to be paid in less than 1 year between 1 to 2 years, 2 to 5 years, and over 5 years. Those disclosures are also forming part of this requirement of standard, and these again can be given by the actuary, because the actuary will know what is the projection year on year and what is the expected outflow, and they will also give, and this has to be an undiscounted amount. So that is another one that they give. So these are the basic and mandatory requirements for disclosures as you look into it in many financial statements. These are expected as required as standard, and these are provided by the actuary themselves. And move on to the next slide. So that brings us to the largely the similar pattern to the end of the defined benefit obligation before we step into the auditing consideration. Just to recap, the short-term, long-term liabilities are the ones employee benefit schemes that are looked into. Again, broken down into defined contribution, defined benefit, long-term need for actuarial valuation versus actual valuation that needs to be looked into. Short-term, typically less than 12 months, so no actual valuation required. Compensated absence, accumulated, non-accumulated, whether any carry forward benefits are available, company allows that facility, in which case then accruals are required. Non-cumulative, then they kind of lapse, so no accruals required. Termination benefits depends upon which part of the life cycle the scheme is, and hence accruals of liabilities becomes relevant. And other long-term benefits follows the same pattern. And disclosures, adequate and abundant disclosures as required by standards are required. And in terms of segregation of actuarial differences going through the P&L vis-a-vis the OCA is again earmarked as per the standard. So now coming to the auditing considerations. Again, this is an expert because we are relying on work of an actuary. So considerations of nature, competency, objectivity, and independence of actuaries need to be documented, looked into in terms of their track record. Again, look back in terms of typically to say on some of the assumptions they've used. Because some of the data are supplied by the company, because actuary will not know the salary escalation rate. Actuary will not, when they say will not know, they will lean on or defer to the management or the company, because company is the one which will know what will be the future salary escalation rate that they are planning. Company will be able to give data on their attrition rate, and so basis which they actually then will do the forecasting. So these are things that when someone is saying the salary growth is going to be at 8%, and this has to be seen in the horizon of the obligation. This is not just the sometimes what may happen is on a long term, if in that example, if you see the disclosure, it's a obligation spread over a 27-year period. So every year the company may be growing at or giving a salary increase of 10%. But then over a period of time, it is not that on year compounded, it will be 10%, so it may become a very high number. So over a period of time, it may even out, and so it may be still 6% or 7%. So one needs to be mindful of not the short-term increase in salary growth rate, but look at it on a wider horizon to see whether it looks reasonable. Because someone may say, look, but the company last year gave 10% increase, but we are seeing only 5% growth rate over a period of 27 years. So one has to look into it over a long-term horizon to say that will the company be giving a year-on-year 10% increase? Chances are unlikely, because there may be years like in COVID time where the salary growth rate may be lesser. So it may even. So the other assumptions, as I said, these are assumptions that you look into. Confirmation of balances. So typically plan assets, if they are with LIC or other insurer, companies as part of audit process, auditors send independent confirmations to the LIC, and LICs and others are responding. They are directly sending responses to the auditors when auditors seek confirmation, because these are fairly significant balances in as a balance sheet line item, and hence as a confirmation process, companies will obviously get their yearly returns, yearly statements from LIC and other insurer. But as auditors, if you send a confirmation independently with the due authorization from the company, the LICs and other insurers are directly responding to the auditor. So that is one other audit procedure that all of us follow, and is a requirement that should be considered. Then valuation experts, which we said, then the if there is discomfort in the expert employed by management as a last resort, and the standard expects that as auditor we employ experts, but that's just the last step, and I don't think generally it happens, but it again depends on the case-to-case basis. And again, appropriate representations in terms of some of the data that has been supplied to the actuary, be it the growth rate, salary growth rate, or escalation rate, all of those needs to be properly represented in the management representation as you get it at the end of the audit. So largely, these are the things that you would look into from an audit consideration standpoint, and of course, controls around all of this if it's an ISC environment, and adequate disclosures being complied with from a requirement of the accounting standard. So to that extent, that brings us to the end of this session as well, and I'm happy to look into the chat box for the questions. So in case of default of bonds like DHFL, will the company have to provide for the same books of accounts of the company when the trust is having adequate reserves to bear the default? So that's a very good question, sir. Because what happens when you say adequate reserves, I'm assuming you are talking about they being positive in that sense in terms of balance even after the projected impairment. But still, I would think you would have to look at, because you're doing a fair value of the investment. While the reserves may be positive, it may still come down or reduce consequent to the impairment required for the bonds. Because what has happened is in the recent past, as I'm sure you would have, all of you would have seen in many of the balance sheets, a lot of companies which have private trusts, PF trusts, which are company-owned trusts, they have taken a lot of hits on account of corporate bonds and investments in ILFS security bonds and DHFL bonds. All of those, because the credit ratings have come back with the D rating, and many of those, and the ILFS themselves had come up with different categories: red, green, orange category. There were companies which had taken those into consideration and considered an impairment of reduction in fair value. So to that extent, irrespective of the companies having adequate reserves, the standard is more to say that the fair value of plan assets have to be considered, and hence you would have to consider this. The only thing is the because these are actually a return on plan asset. These could necessarily, you don't need to go through the P&L, can go through OCA. So these could be considered like an actuarial assumption change, because the return on plan assets has undergone a change because of the impairment. And so any reduction would can go through the OCA instead of the P&L. So to the extent the P&L is protected, but goes to the OCA. And the next question is, salary percentage, increase percentage will be the base for eligible employee salary or for all employees? So typically, sir, it would be, when you say eligible employees, I'm assuming it's a question to say that if they have crossed 5 years in the case of gratuity, or for employees who have not crossed the 5 years threshold. If that is the question, sir, the gratuity provisions expects, as a company, you also anticipate how many people will, the companies don't necessarily start providing only for those employees who have completed 5 years with the organization. Even let's say if I join the organization today, the companies, based on their track record, would expect that I as an employee may stay put in an organization for more than 5 years. And so they would prorate it for the number of years of service and arrive at the gratuity for even for me. So that is the expectation, and to say that, so hence accordingly, if that be the consideration, all employees will be technically eligible. The only thing is the liability may differ because I might not have crossed 5 years threshold, and so that would get automatically trued up or down depending upon a year-on-year remeasurement. Because if, let's say, if I'm not there in the company next year, then automatically the liability will get reduced but get factored for increase thereafter elsewhere. So that is an assumption-based computation that actually does, and so all employees technically will be from day one will be considered, even though in the strictest sense of the act they have not completed 5 years. But the expectation for the companies, because they have rendered services in the current year from a matching concept, there has to be an accrual. That accrual is determined based on what is the average period that any employee stays in the organization. So that is an assumption that actually factor. First, I have answered that question, sir. If eligible employees was to be read that way.
Is there any other questions to address? We'll just wait for 1 or 2 minutes, and then we can.
Sure.
One thing is we can share this presentation with our members, right? So,
sure, sir. I will send you. I'll send you the version, sir. Probably this one. Just 1 or 2 small changes I have to make in the context of whatever I noticed. I will just make that and send it across so that you can share it with the members.
Yes. So I just try to unmute the permission to unmute the members, so they can unmute themselves and they can ask the question if any. If not, we'll end up the session.
Sure.
Hi, it's Arun here. Can you quickly refresh the 4 steps for the long-term benefits measurement?
Sure. Yeah. So first is to determine the defined benefit obligation, which the actuary will do based on what is the future. They would look into various presumptions to say what is the obligation in respect of gratuity for the existing set of employees, because you would be the set of data where all the employees who are there on the rolls today, and then the actuary would say what is the future obligation based on the period of service and all other factors. So first, the defined obligation has to be picked up by the actuary, and that could have also certain other factors to look into, which is the future salary growth rate, the attrition rate of the employees in the company, and also looking into what are the mortality rate and other assumptions. So once that is done, then the next step is to see what is the fair value of plan assets. So that fair value plan assets will be with the insurer managed funds. So if it's insurer managed funds, you will get a balance from, let's say, LIC or any other insurer. So you would know what is the net liability. So the first the liability which determined the present value of that, if it's determined to be 100 rupees, because once they do the future cash flows, they will do the present value, because you're going to settle them in, let's say, year 3, year 4, year 5, year 7. So they actually would know what would be the present value of it. So they would discount it and arrive at the present value. You then compare that with the fair value of the plan asset, which is available from the insurer. So let's say that comes to 75 and 100 was the obligation. So the net obligation is 25. Then so that is what will be disclosed in the accounts and liability, and that whatever is the charge for the current year will also be determined based on in this movement, because they will say what is the opening liability, what is the charge new accretion in the current period, what is settled in the period, and then what is the closing liability. And hence whatever is the charge for the year will also be broken down between what is going to be entered, which is nothing but the current service cost, past service cost, and interest cost. And what will go to OCA is purely the actuarial assumption changes, which is nothing but, let's say, last year the discount rate was 6%, it has become 7% because of the liability will undergo change. And similarly, if it is growth rate was salary growth was 8%, now it's come down to 7%. All of those will go through OCA, other comprehensive income, because these are actuarial assumption changes. So those are the ones that will have a P&L impact and OCA impact. So this is again one that we do. And let's say, and then the next, and typically these are the 3 steps. In between, there's a step 2, which is nothing, which is not very common. You don't see it more often, which is where effectively, if you have, let's say, in this instance, they said the present value of the obligation is 100 and the fair value of the plan asset is 110, then you have a net asset, net benefit asset. The benefit is in that because you have 10 rupees, which is actually you paid more to the fund than what is your liability, which then needs to be factored for saying whether this 10 can be utilized in future as a refund, whether you get a refund or whether you will be able to adjust it, set it off against future contributions, and whatever will be the amount that may not be receivable as refund, you reduce it from that 10, so it comes to 7 or 6. If let's say 4 is not, you're not entitled, because if all of them were to be paid off and 6 is the obligation, and then effectively only what you will get is only for you, what is left in the fund is 4. That 4 will not come to you because it is an employee-related contribution. So then you reduce it and take it, bring it down. So that is the 4th step. So these are the 4 steps that you will do.
Okay, got it. Thanks.
So just wait for 1 more minute. If there is no more queries, we'll might ask.
Sure.
So if there is any queries, members can post it in chat box or else we'll...
This is Hemant.
Yes, sir, please.
Actually, it's with regard to my question. If the trust has invested in, say, DHFL, a private trust, employee benefit trust, PF trust, has invested in DHFL, and there are adequate reserves in the trust of in the PF trust, should the company, say suppose the main company of which the employees have created a trust, should the company also provide for the DHFL, I mean, revaluation and all? If that isn't, because
Arun sir, you're muted. Sorry, unmute yourself.
Sorry. But sir, when you mean reserve, are you saying they carry a provision in the trust accounts?
Let him unmute.
Mr. Hemant?
yes, sir. Yes, sir. There is provision in the trust which is created. So should the company also provide for this?
So they may not separately provide, sir, because it is indirectly covered. Because what will happen is, if let's say, I'm just making an example, the bond A is 100 rupees, and the trust is also considered provision of 100 because the bond A is a D-rated bond now. So the fair value of the plan asset, if that's, let's say, that's the only asset in place, the fair value of plan asset is 0 as far as the trust is concerned. So when the company does a comparison of the liability and the balance, then they will automatically have to bring that forth in their books, because they will say that earlier it was 100, last year it was 100, now it has become 0, so the liability is automatically covered. So you don't need to separately create any provision. By virtue, if the trust has done this provisioning, automatically that will get factored. There are instances where the trust sometimes does not do it, because they may ideally it cannot be inconsistent, but sometimes there could be a timing issue because the trust may not be audited on time. Trust may have some more time to get audited. Audit accounts get audited before, because you may have a filing process, let's say for listed company before May, whereas the trust has some more time. So in those kind of instances, what may happen is that the company may take a provision on their books and reduce the fair value of the plan assets. Otherwise, if the trust is already considered that, then you're only taking the net balance as the fair value of the plan. So automatically it will get factored into the company as well. Sorry, I meant reserves. I thought the surplus corpus. Yeah, exactly.
Yeah. Right, sir. Thank you. Thank you.
Sure, sir. I see Mr. Nataraj's question on eligible. So probably it's not the gratuity period. So then in that case, what is eligible is only we will take, sir, because typically then you only go with whatever is the growth rate. If employees are not, because you look into what is the percentage of increase year on year, and that is at a various grade level you see, and then take that into consideration. The only thing is, what may happen, sir, is today, let us say I'm not eligible, but if I'm expected to stay in the organization for more than 1 year, then technically by next year that person will have a increase in salary. So in a way, you will still consider for those people today who are ineligible, because you expect them to stay for a longer period of time, what could be the projected increase in their salary? Let's say 3 years down the line they were to leave the organization, or 5 years down the line they leave the organization. What's the gratuity pay? So even though they are ineligible today, but they may be under the presumption of staying for a longer period of time, eligible for a period. So you look forward and then take that into consideration. If there is no other question, I really thank the SIRC and all the members for patiently listening to me, and thanks for this opportunity.
Thank you, sir. And one minute, is there any other question? So those were the questions it seems. So one of our RC member finding it difficult to join as he has network issue. I take a pleasure of proposing vote of thanks, sir, on behalf
Sure.
of SIRC. And I thank you on behalf of our chairman, secretary, and our regional council member.
Sure. Thank you.
Addressing our members on weekend Ind AS session on Ind AS topic 113 and 19. And we thank you for taking a time out of a busy schedule and addressing our members on Sunday morning 7:30. We have close to 150 participants attending throughout the session. We have close to 150 as of now. So thank you for excellent presentation, sir. And we look forward to have you on the next session also.
Sure. Thank you.
Thank you very much.